Another week, another bank. Hello, everyone. Monty here, market analyst at IG UAE. Quite a bit to process, as has been the case over the past few weeks. It's not my doing. This is just what's been happening as of late. Deutsche Bank, that's the latest one. Share price did take a tumble, has managed to recover a little bit off the lows. A lot of policymakers in the Eurozone, as well as in the US, coming out going, hold on a second, banking system sound and resilient. Have no fear. The bank, especially, that's been enjoying consecutive quarters of profit. So this isn't what should be happening. But the bottom line is that when you look at credit crunch versus a credit crisis, on the one hand, a credit crunch, that's when banks make it difficult to really lend out money to households and corporates. That's expected to continue no matter what happens next. Fed's Powell last Wednesday pretty much clarifying that bit. But credit crisis, where banks have difficulty lending between themselves, well, that's something that hopefully we're hoping is going to be averted. Though looking at it from a liquidity standpoint, discount window use still high, not as high as the week prior when it started with Silicon Valley, but where it has risen is when it comes to the Fed's bank term funding program for around over $10 billion to over $50 billion. That's where they start to take on liquidity on the assets that they already have, but at par, not with those high unrealized losses that we talked about prior. And of course, FEMA repurposed facility when it comes to those foreign banks. That took quite a bit of a spike. So overall markets for now, it's 50-50 on whether or not we can get another rate hike in the next Fed meeting. It was and could still be. I know these market pricing continue to change significantly. What majority on a lack of a rate hike, that this is essentially the peak range that we're in right now, 4.75 to 5 out of the Fed, and that we'd be majority anticipating rate cuts out of the Fed from September onwards. So still pretty much in crisis mode, and that essentially that looking across the FX majors, the key central banks, we are either in a hawkish pause slash dovish hike situation at best when it comes to pretty much all the central banks for the FX majors. So that's when it comes to that. We want to go in and take a look at what's in terms of the week ahead. Aside from processing banking stress, we do have quite a bit of pricing data. I know the CPI for Australia, I'm going to put up the weekly market report in just a bit, but when it comes to taking a look at pricing data of the US and the Eurozone, for the US, these are going to be figures for February. It's going to be both for the US and Eurozone, going to be released on Friday. PCE price index. Now, these were the figures for January, so they got released in February for January. We saw that so far, still well above the Fed's target, and the expectation is that month-on-month growth is going to be lower, 0.2% month-on-month, and then when you take core, removing your food and energy, we're looking at growth of 0.4% instead of 0.6%, but crucially, the year-on-year readings are expected to decline. 5.4, only a notch lower to 5.3%, and for its core from 4.7 to 4.4%. Now, this runs in contrast. The reason why I'm bringing this up first is not just because it's expected to be something significant, so too when it comes to some of the other items available on Friday, like personal income and personal spending. When we go to take a look at the Eurozone preliminary harmonized index of consumer prices, this is for the month of March, and what I want to do is I've taken a slightly different approach here, and that's because I want to show you how it's been the year-on-year reading, how it has progressed since October was 10.7%, and then after we had these declines, November, December, and zooming to January and February, bit sticker at 8.5%. The expectation is that on Friday, the number for March is going to drop into the 7% handle, well into the lower 7% handle, I should say. But take a look what's happening when it comes to core. 5% back in October, 5.2% in January, 5.6% February, and the expectation is it's going to keep rising. So yeah, at the headline reading, you're seeing them drop year on year. It's dropping, but the core, sticky part, still rising, and that of course is going to be issue. And just want to go ahead and pull up the market report right now, the weekly market report. The link for this, by the way, it's available in the description for those of you that are interested. But we're also going to have Australian CPI on Wednesday, and also Tokyo CPI. That's also an important one, just because it comes well ahead of the national CPI reading. So that is going to be something to note. That's going to be on Friday morning. We did get corporate service pricing data this morning. It was a bit higher than expected, rising up to 1.8%. Finally, just want to pull up the platform. A lot of you do trade NASDAQ 100, for those of you wondering, and a lot of you are heavy on when it comes to tech stocks. I'm not saying that's got to be the case, but weekly market report, we usually have a nice, it's FX, commodities, crypto, as well as indices. But just want to show that so far, tech, not just doing relatively well, but outperforming against both Dow and S&P last week. So, futures are pointing a little bit lower, but so far it has managed to, let's just say, been a bit calmer as of late. I know it's a bit of an odd moment when it comes to the markets, because on the one hand, investors have been going towards traditional safe haven products, primarily treasuries, and then they're trying to shun riskier bonds. But at the same time, we're seeing that there's been this flow towards tech, and to some extent, crypto also relatively outperforming, and obviously some of those cyclicals doing worse or underperforming, specifically financials for the obvious reasons. Uh, Now they obviously like the fact that yields are lower. They'd like the fact that maybe we're past the peak in terms of Fed hawkishness, but a lot of times it means that if we're relying on some of these tech heavyweights to outperform and to sort of help keep the market at these levels, it just means that we have to know what's going to happen with those key few names that now have a more sizable weighting when it comes to these indices that we're following. So that's a bit about it from our end. Do hope you enjoyed this, and happy takes.